Hello investors and future investors, welcome back to the channel. In today's video, I'm going to show you a trade I plan to execute come market open on Monday. That is why I needed to watch this before Monday. My name is Tim. Welcome to Investment Gains. Let's jump right into it. Welcome back investors and future investors. Now for today's option video is going to be a more comprehensive and detailed video. I want you to understand exactly what I'm doing. Today's strategy is going to involve three option strategy in order for me to get my desired result. Now, you guys know how we do it on this channel. We like to get down and dirty with options, meaning we like to practice our option in order for us to get better and better every single trade. Now, for today's video, we're going to be using none other than Sound AI, ticker SOUN. Okay, so here I am on Sound AI. So a couple of days ago, I did go live and show you guys how to do some basic due diligence if you guys are new to options trading. Now, this option strategy is going to be perfect if you're trading with a small account because you're going to be able to get more bang for your buck. Now, let's do some basic due diligence on Sound AI before we even get into the strategies we're going to implement. Now, first off, you want to see what the stock price is trading at. And the stock price is trading at 14.73. Remember that? That's going to be extremely important throughout this video. Now we're going to go over to the advanced feature and then we're going to go to 1Y or 1 year. Now the reason I took you to this screen is for you to see one of the indicators that I use the majority of the time, and that's going to be the MA200 or 200-day moving average, and that's going to be represented by this blue line. Now, this blue line shows us how the stock has been trading like on an average for the last 200 days. Now, if you were to go all the way out to this line, you're going to see that Sound AI has been trading around the $5 mark, roughly give or take. But currently, Sound AI is trading at, like we just saw, $14.73. Keep that in mind. Once again, that's going to become very important going back to this video. All right, so let's get out of this now and go back to the Sound stock, and we're going to begin our option strategies. Okay, number one, now we're going to go and we're going to open up the options chain. In order for us to do that, we need to go and make sure we go to Trade Sound Options. Now that the option chain is open, our first strategy is going to involve buying a call. So let's first make sure it says buy and call, and now we're going to go ahead and choose our expiration date. So the expiration date for this first strategy, I'm going to go a far out expiration date. I'm going to go for September 19th, 2025. And as you can see here, that gives me about 286 days before this option trade expires. Now, this option strategy is going to be known as either buying a long call or a LEAPS option. LEAP stands for long-term equity anticipation securities. Good. Now, in order to maximize the efficiency of this option strategy, it's highly advisable that you choose your strike price below the current share price. Now, once again, I did remind you, keep the share price in mind. So the share price is 14.73, and now we're going to select our strike price, and we're going to go below that price, and I'm going to be going with you guessed it, the $5 strike price. So you did see why I chose a $5 strike price, because I did some basic due diligence. Not as much as I should, but that's just basic. So I'm going to pick up this strike price, $5. I have a delta of 0.96. Also remember this. We're going to go back to this shortly. Now, in order for me to pick up this option strategy or LEAPS option, I'm going to have to pay 11.30 or $1,130. So why did I choose the $5 strike price as opposed to the other strike prices? Well, I just showed you the basic due diligence. I'm going to show you something else as well. And for that, let's go ahead and click into the strike price. Once you click into the strike price, that's going to open up what is known as the Greeks. Now, as you can see here, the delta on this bad boy is 0.96. So that's extremely high. The delta effectively tells you that every price movement of $1 in this stock, either up or down, is going to give you an equal movement in your option of 0.96. So it's pretty much 1-to-1 at this case. Another thing I chose the $5 strike price for is the implied volatility. The implied volatility is not as bad as I've seen before, but it's all right. Remember, the higher the IV right here, the more premium you're going to be receiving. All right, now, so we're going to go ahead, go out, and then we're going to go ahead and select this strike price. So it's going to be 11.3. We're going to hit continue, and voila, like I said, long call or LEAPS option. Now, a key factor to note, whenever you buy a long call option strategy or a leaps option strategy, that gives you the controlling interest of 100 shares of that stock. It does not mean that you actually own 100 shares, but you're able to control 100 shares. Now, if you were to look at the price here, the share price once again is 14.73, but I'm picking up a leaps option at 11.3. Now, the difference between the two is not that much. It should be around $340. So I know you're asking yourself this question: why don't I just buy 100 shares outright at 14.3? Well, very good question. Now, I did show you before the basic due diligence. The stock has been on an incline for a long period of time, and the spike is extremely high, and that's extremely volatile. If I were to pick up 100 shares, I would have to pay $1,473. Now, if the stock price were to retrace back down to $5, then my option and my overall portfolio is going to be down the difference, which should be around $700. Is that a risk I'm willing to take? No. So that's why I opt for the leaps option instead. Now, with the leaps option, if the stock price were to have a slight retracement and find its way back to $5, it's not going to be that bad because the strike price I chose was $5. Good. That's my reasoning behind doing this. Now, you must have a leaps option in your portfolio in order for you to do the other remaining strategies. All right. So now we're going to pretend we're going to buy this option strategy. So if you guys are getting any value so far, remember to go ahead, like the video, subscribe to the channel, and hit those notification bells. So whenever I post a video, you guys get notified right away. So let's go. I did say there's going to be 3 different option strategies that will be implemented. So that's number 1. Number 2, we're going to go out of this one, and now we're going to go over to sell and call. Now we're going to choose an even closer strike date. Let's go ahead with the strike date. I'm going to choose December 20th, which gives me around 13 days. So let's go ahead and select that bad boy. Now I'm going to go ahead and choose my strike price. Remember this, above the current share price. Remember the previous option strategy, which was a leaps option. I chose my strike price below the current share price. Now I'm going the opposite direction. I'm going to choose my strike price above the current share price. Now the strike price I'm going to go with is going to be, let's go ahead and keep scrolling up, and I'm going to be going with the, let's say, the $22 strike price. Now, with the $22 strike price, that gives me a chance of profitability of around 88% or close to 90%. Now, also, in addition to that, because I'm selling a call, I will be receiving 0.65 or $65. Each option contract is multiplied by 100 shares. Now, I know what you're asking yourself again. Why did I go ahead and choose the $22 strike price when I went past all of these strike prices right here? Once again, that's a very good question. So here is my thinking behind this. The current stock price, once again, is at $14.73. The stock price could shoot up to $22 at any point in time. However, if it does go to $22, I will benefit from what's called stock appreciation. So now the leaps in my portfolio is going to go up to the equal one. Let's say it's a 1-to-1 with the delta. So the difference between, let's say, $15 and $22 is going to be $7. So my overall option is going to go up by $700. However, it does not end there. If that were to happen, not only am I going to be up $700, I will also be up the $65 I receive as premium once I go ahead and I do this option strategy. Now, another reason that I chose the $22 strike price as opposed to the others, let's once again go into the Greeks. Now, hopefully you remembered that the strike price I chose as my leaps option was 0.96 delta. So now I'm almost about 2 weeks out with my strike date, and the delta I chose is 0.23. Once again, there is a reason for that. So here's the reason behind this. Whenever you get a leaps option or a long call and you decide to sell cover calls against it, the rule of thumb is to make sure your delta is equal to 0.1. Now, 0.96 plus 0.1 is going to be exactly 100. But the fact that I went out 2 weeks, I decided to go with 0.23. So let me show you. Let's go ahead. We're going to go to 1 week, which is going to be December 13th. And now we're going to go ahead. We're going to choose the exact same strike price, which was $22. And we're going to go into the Greeks and see if we have a winner. Okay, voila. So here we are in the Greeks, and you can see the delta here is 0.1. And once again, that's going to be equal to 0.9 plus 0.1 is going to give you equal to 100. That is just a rule of thumb. That's just something I picked up as I kept trading over the years. So let's go ahead to our desired strike date, which is going to be December 20th. Okay, and we're going to go back to our $22 strike price, and we're going to continue to going through some of the items on the Greeks. Now, the implied volatility here, I did mention I have seen some crazy implied volatility, and there you have it right now. This is 214% IV. That is extremely crazy. That's extremely high. So this trade is not for the weak at heart, or I would not advise this for anyone that's new to trading. But I do like the IV. It's allowing me to get some decent premium. Now, if I were to divide the $65 that I'm going to receive right here by the amount of money I paid for it, so 65 divided by $1,130, which I paid to acquire the Leaps option, that should give me roughly around 5.7%, which I'm totally satisfied with. Now, a 5% return in 2 weeks, that's extremely high. But look at it this way. If I were to do it for just 1 week, it'd be about a 3% return, which is not that risky, at least in my opinion. So that is the option strategy that I'm going to be using. I will go ahead and execute a Leaps option at the $5 strike price. I'm going to pay roughly around $1,130 for it. And I'm going to turn around now and make some consistent premium by selling covered calls against it. So the first option strategy is a Leaps option strategy. The second option strategy that we're going to do here is called the covered call option strategy. These two strategies put together is what's then known as the PMCC, or poor man's covered call. Now, I did say this is perfect for anyone trading with a small account. If you're trading with a small account, you're now going to be able to leverage only $1,100 in your portfolio in order to make around a 3 to 5% gain on a regular basis. Now, although this is trading on a stock with high IV, the smaller your account is, the more risks you may need to take. The bigger your account is, the more you focus on conserving your capital. So there you have it. This is what I'm going to be doing come Monday morning when the stock market opens. Now, it would be remiss of me if I did not mention the dangers of doing these option strategies. Okay, so let's say in a couple of weeks on December 20th, Sound AI decided to drop to my $5 strike price for my Leaps. All that's going to happen is that my Leaps option is going to be down. But once it does not pass the $5 strike price, I'm still good. I can still trade covered calls. Now, if it were to go below the $5 mark, that is also still fine. As you can see, when I showed you the 200-day moving average, the stock was trading for that price for a very long time. So if the stock does fall below the $5 mark, it's almost guaranteed it's gonna recover to $5 or above. The amount of time it's gonna take, no one knows, but it will recover. So that part is very safe according to my own risk tolerance. Now, also, let's say come expiration date of December 20th, and the stock price is way past the $22 mark. Then now I'm gonna lose my Leaps option. But remember, there's a couple of ways you could do this. You could either do nothing, and Robinhood is going to close out your sell call, and they're also going to close out your Leaps option. The difference is going to be the $700 plus the $65, which is going to leave you with a gain of $765. So this is why I like to trade for income. This is a win-win option strategy. Now, let's say it goes a different way and come once again, December 20th, and the share price does not hit $22, it's anything way below $22, then guess what? You're gonna keep your Leaps option and you're gonna rinse and repeat until you get a sign or until you decide to get rid of your Leaps option. Now, there's also other stuff that can be done with your Leaps option. If your Leaps option become anywhere in danger of you losing it and you don't want to lose it, there are options you can take. Now, I did say options, no pun intended. You could decide either to close it out for a gain, or you could decide to roll it out for a further date. If you guys do want me to make a video about how to roll out your Leaps option, please let me know in the comments below. Now, if you guys have any questions concerning these three option strategies, the Leaps option, the covered call, and the PMCC, feel free to leave me a message in the comments below. Now, also, I would love to know what my subscribers are trading. What option strategies are you guys using to build your portfolio? Please let me know again in the comments below. Now, until the next video, keep pushing your investment. And also remember, subscribe to the channel, hit the notification bell, and also like the video. But most importantly, please share the video with someone you think that can benefit from its content. There's so many of us out there that are trying to leave our 9 to 5 to try to get some extra income. Why not help each other out? So until the next video, keep pushing your investments.